This is Asia Trade. I'm Shery in Tokyo alongside Paul Allen in Sydney. The top stories this hour. Asian shares set to follow Wall Street lower as Brent crude jumps, with Iran and the U.S. exchanging fire in the Persian Gulf. President Trump says the war could go on for 2 to 3 weeks. The U.S. military says it fought off Iranian boats, drones and missiles, with the UAE also coming under attack for the first time in about a month. Also ahead, a third straight RBA rate hike expected today on war-driven inflation risks. Today's move would unwind all of last year's cuts. And we're live at the Milken Institute Global Conference in Beverly Hills, speaking with Starwood CEO Barry Sternlicht.
All right, let's take a look at how our Australian futures are shaping up. Shery mentioned there that it's going to be a big day with that decision from the Reserve Bank of Australia. We could get a third consecutive rate increase that would take us to 4.35%. So that's weighing on equities futures. You see S&P futures off 0.8%, and that's before we even get into the question of the escalation in the state of Hormuz. We'll get to you more on that in a moment. The Aussie dollar holding up pretty well under these circumstances. One of the few currencies globally that have strengthened since the start of the war, 71.67 at the moment, and we'll keep an eye on that as we get closer to the Reserve Bank decision. That's at 2:30 p.m. local time. Also, we've got US futures kind of flat at the moment. They gave up a little bit of ground, off about 0.4% on the S&P as that tension escalated in Iran again. Now, let's take a look at what the impact on the oil price was. It was quite profound. We've got Brent moving up, last close $114.44. For pretty obvious reasons. The US did manage to escort 2 US-flagged vessels through the Strait of Hormuz. The US military managed to do that, but 7 Iranian fast boats were fired upon. There was also an Iranian strike on assets in the United Arab Emirates. So things not looking good. And if you can take a look at that chart on the right, interesting inverse correlation there between the price of oil and the white line is polymarket bets on this getting resolved by the end of the month. That's now sitting at about 15%. Well, let's get the latest on the war in Iran and Washington's push for Asian nations to join its operations in the Strait of Hormuz. We're joined by Senior Editor for US Economics and Government, Derek Wallbank. China correspondent Min Lo is with us as well. And our Senior Editor for Markets, John Authers, also joining us. Thank you all. Derek, let's start with you. The events we saw today really do underscore the fragility of the situation in the Strait of Hormuz at the moment. How realistic is it for the US to continue with these military escorts?
Well, Paul, I think that's exactly right. And the word that you used, fragility, is one that I would absolutely hang on there a bit. You know, we had seen this ceasefire between the United States and Iran hold broadly since it was put into place in early April. Now, that's sort of all been brought into question. You know, we've seen some very limited, I would describe it as, exchanges here in the overnight hours Asia time. You know, you did see the United Arab Emirates have its air defense systems engage with some 12 ballistic missiles, some cruise missiles, some drones, etc., like that. And the U.S. is very clearly trying to blast through the blockade in the Strait of Hormuz. So that's all sort of going on right now. What you did not see, though, and President Trump had several opportunities to address this today, what you did not see from the United States was Donald Trump saying that the ceasefire is over. And in fact, you're also seeing some comments from Iran suggesting that there have been some progress in the talks, or at least there's some movement in the talks. So you are seeing the leaders right now engaging in sort of verbal efforts to kind of keep things on the rails. Now, will that hold overnight American time through the Asia day into the Iranian morning? You know, that's really an open question. We do have a press conference from the Pentagon awaiting tomorrow morning U.S. time, so we should get some more details on this then.
Yeah, certainly the intent from some of these remarks seems to be leaning towards let's find a solution. But, you know, I had a look at that chart before of poly-market expectations sitting at only 15% that we get this resolved by the end of the month. So the flip side of that is, what's the risk of escalation here?
Yeah, well, and I think one of the things that's really difficult with this is the idea of solution, right? Donald Trump has drawn some red lines that he said for Iran that go way beyond what Iran has suggested that it's willing to negotiate. And that becomes a sort of problem if that's your off-ramp, right? If there's nothing necessarily, in the middle of that or before that that gets you off. But, there's interestingly enough in this conflict, there's sort of a line short of a solution that is basically a kind of status quo of no further escalation. And I think that's really a question that we have. Does that hold? Is that going to be something that kind of snaps back into place? Or is this something that provokes escalation after escalation after escalation? All of a sudden we're back in more fuego in that part of the world. And so I think what you're looking at here, Paul, is a kind of fork in the road. Either you have an escalatory track that can be there, or there's some way that this becomes an aberration and things go back towards a sort of stasis. Stasis not great for everybody, but stasis being better than a re-escalation of fighting.
Yeah, especially if you have sporadic episodes of violence, right? Our senior editor for U.S. Economics and Government, Derek Wallbank, there. And let's bring in Mingmin Lo into this conversation as well, because we're now hearing from the Trump administration asking U.S. allies in Asia, including South Korea, even China, to join operations by the United States in order to reopen the Strait of Hormuz. 3 months into this war, how likely is this to happen?
Yeah, we have heard such demands from the U.S. and it is quite unlikely, right? China's stance has been very consistent. It's always been calling for a peaceful end to the war, and it's unlikely that it will want to commit naval asset to the region that could potentially, while on the one hand, the U.S. is saying it's helping to escort ships out of the region, but it could potentially escalate things even further, especially as Iran has resumed attacks again overnight after it made threats on U.S. ships, saying that U.S. ships that approach the region would be attacked, and calling on all ships to seek permission before crossing the strait. And the same thing with South Korea as well. President Trump made that request to South Korea, saying after South Korea's cargo ship was shot by Iran, saying that ship did not have an escort. And so perhaps it's time for South Korea to join the mission. But again, we have heard the South Korean defense minister said before that, dispatching a warship to the strait to act as an escort, that is something that will require parliamentary approval and is not likely to be something that is taken lightly.
And of course, President Trump had to delay his summit with President Xi Jinping because of the ongoing war. Are we going to actually see the summit take place now, mid-May?
Well, all signs are pointing to that summit possibly going to happen, because just overnight on Monday, President Trump said again that he's looking forward to meeting President Xi in 2 weeks' time, that it is going to be a very important meeting. And just last week, we saw a series of phone calls between the trade representatives of both sides, Hurley Feng and Scott Bessent. There was another phone call between the foreign ministers as well, the Chinese Foreign Minister Wang Yi and the Secretary of State Marco Rubio, all of these pointing to perhaps the preparatory work underway to lay the path for that summit in mid-May. And of course, the Iran war is going to be that overhang, right? Particularly after the U.S. had placed sanctions on Chinese oil refiners, and China responded by calling on companies not to abide by those sanctions in the first application of this legal instrument that China has introduced back in 2021 to push back against what they see as long-arm jurisdiction from countries like the U.S. So it will certainly be interesting to watch how the U.S. responds to this, but it does seem like both sides seem intent on keeping that relationship on track. We're also watching for any indication of whether China would make any courtesy purchases of soybeans from the U.S. as they did the last time prior to the last Trump-Xi summit in South Korea, because if you look at soybeans futures right now, it is at a near-term high, the highest since mid-March, and that's coming as traders are hoping that China would purchase more old crop U.S. soybeans in the coming summer months.
Yeah, Bloomberg's China correspondent Min Lo there with the latest on those talks between the U.S. and China that we're expecting. In the meantime, of course, we're just following all of this market turmoil. We have Brent near a 4-year peak. We have seen the pressure on U.S. stocks, Treasury selling off. Let's actually bring in John Authers to discuss all of this. I mentioned the turmoil in the markets, John, but with oil above $100, with yields at multi-decade highs, we're talking about the 10-year yield past 440. The impact has not been felt that greatly in the U.S. stock markets, dare I say, especially compared to the March sell-off. What's going on?
Well, it's been remarkably minimal, the impact on the U.S. stocks, which are still very closely at a high. If you want one particularly dramatic way of illustrating that, it's the if you look at the equity risk premium, where you take the earnings yield on the S&P, that's the inverse of the PE. So the yield you effectively get from stocks, and subtract the 10-year Treasury yield, it's gone negative. You're actually penalised for taking the risk of buying stocks, and apart from a very brief window just when Donald Trump had won re-election, the only time that's been true before has been at the top of the dot-com bubble. So this is a remarkably strong performance by the stock market. I think it's based on two things. One is that there is an implicit judgment that the oil price is manageable. Not that it's great, but that it's manageable enough that it's not going to impede growth, at least in those areas that the US stock market cares about the most. One very interesting measure of that is, I think what was very intriguing today was that the price of Brent for December in the futures market topped $90 for the first time. That tells you are definitely getting very worried, but that you also don't think that the oil price is going to tank the global economy, or it wouldn't be that high.
John, in 6 months to the day, it's the US midterms. One assumes something needs to happen by then. The question, I guess, is what?
It's very difficult. Donald Trump has shown a great ability to declare victory and get large numbers of people to believe him. The question is whether that option remains open in this case when he has an opponent, the Iranian government, that really badly does not want to let him get away with doing that. The critical point has to be oil prices. Again, that's why you're seeing so much interest in getting oil through the strait one way or another. You need to keep it under some kind of control. Look for other modes of getting it out there. But you're certainly right. If you were looking at prediction markets, betting on whether the strait opens, it's not coincidental that prediction markets don't think the strait is going to open even by the end of next month, and they also think that Democrats are now likely to take control of the Senate as well as the House, which would be not something people really thought as a serious option even 3 months ago, and would really change the entire dynamic of Washington for the last 2 years of Trump's term.
All right, that's Bloomberg opinion columnist John Authers there. Still to come, the Aussie dollar's rally may fade, with the RBA expected to signal a slower pace of rate increases after today's widely expected hike. We'll have a preview next. This is Bloomberg. Australia's central bank is set to raise its cash rate to 4.35% later on Tuesday, with the Middle East energy shock helping to keep inflation above its target band. Let's get to Bloomberg's Asia-Pacific economy reporter, Swati Pandey now. So, Swati, there is an expectation we will see a hike today, but the March vote was very close. Is there a chance we'll get a surprise?
It is quite possible. I think the Bloomberg survey is overwhelmingly showing there will be a hike, but economists who have predicted a hike are also saying that it's going to be a line ball call. It's going to be a really close decision. If the war in the Middle East had not broken out, it would have been a more clear-cut decision. But higher energy prices and the demand destruction that will happen as a result of this, if the RBA board members are focused on that, they may decide to hold and watch like their other counterparts from BOJ and Fed have done.
We're going to get a new set of forecasts today as well. What are we expecting to hear for commentary around inflation, fuel prices, also growth?
Yes, I think the RBA will, I'm pretty sure they will publish scenarios because they had flagged it in recent speeches and public commentary that they are working on different scenarios. If the war is extended, then what happens to fuel prices and Australian inflation and economic growth and unemployment? If the war is kind of finished and the uncertainty has ended, then what are the scenarios? I think they will focus on the extended uncertainty scenario and their forecasts are based on market pricing for interest rates. So they do not predict where interest rates would go, unlike the Fed. And market pricing is actually currently for 2 more hikes, including today. So if their projections show that in spite of 2 more hikes, inflation is not returning to the target band, then they will sound a lot more hawkish. Whereas if the projections are showing a slowdown in growth and higher unemployment, and as a result of that, a slowdown in cooling down in inflation, they may hike today and then sound a kind of balanced or even a little bit dovish.
How is the economy set up to absorb these increases? Because the jobs market is still reasonably robust, right?
Yes, the labor market has surprised everybody. We have unemployment near historically low of 4.3%. We had jobs data earlier this week, jobs vacancies data, earlier this week, and job vacancies have fallen a little bit, but they still remain above December 2025 levels. So there is huge demand for labor. There are some sectors that are still saying they have a labor crunch. So far, it does look like the job market is doing all right, but it could be, things could unravel really quickly, and businesses, we saw in the business sentiment data that it had fallen in the negative territory, in the pessimistic territory. So businesses could decide they don't want to fill those open positions or even lay off staff. We haven't seen that, but it's a matter of time. You never know.
Sari Pandey there, Bloomberg's Asia-Pacific economy reporter, and of course with those expectations of another rate hike coming from the RBA. The Aussie dollar has been one of the big gainers among G10 currencies. This is the WCRS Go function on the Bloomberg, and you can see it's the second best G10 performing currency year to date. One of the big losers, though, the Japanese yen, you can see it right there in the red. We have, of course, seen potential intervention from authorities last week after the yen topped that 160 level against the U.S. dollar. And we are seeing more volatility this week as well. Let's get more now from our chief Asia FX and rates correspondent, Ruth Carson. Ruth, so we actually saw the yen spike towards 155 just yesterday. What's going on? Are those series of multiple short-term follow-ups to initial intervention that we've seen from authorities in Japan in the past?
Absolutely. So it's been very exciting watching the yen. And if you pull up the chart over the last 4 days, you will actually see something very fascinating, which is every single time dollar yen hits around the 157 level, boom, it falls. So it does make the question, is it a series of intervention? And talking to, a flurry of traders, money managers yesterday to try and figure out what is going on, there's certainly a split camp happening. Some saying, you know what, it's actually just thin liquidity, and people are incredibly jittery. So as soon as dollar yen hits 157, you go, ooh, do you really want to challenge the authorities here, take some profit and move on? Or there are those also in the camp who say, no, look at the pattern. It's telling you something very significant. We know the line in the sand for authorities is around 160 now. Is 157 something they're defending too?
And Ruth, we know the Japanese authorities have plenty of firepower to continue if they wanted to.
Absolutely. Goldman Sachs actually did some analysis on this, and they came up with a figure. 30 more times of the scale that we saw last week. In other words, they can go into the market again 30 more times to the same extent. If you're a yen bear, is that something you really want to go up against? Now, no one is suggesting, and Goldman Sachs is suggesting that they're going to use all their foreign, exchange reserves to defend the yen. But theoretically, they could. So it's a very clear and very strong warning shot there to the speculators out there. We are watching you. And do you really want to short the yen at these levels, knowing full well Japan has plenty of arsenal to defend their currency?
At the same time, you have to wonder whether Japanese authorities want to do this, right? I mean, is it a yen weakness story? Is it a U.S. dollar strength story, especially when we have higher yields and expectations that inflation could stay elevated, given, of course, the ongoing war in Iran?
Yeah, in many ways, that's a great question, Shery, because in many ways, it's not just a Japan or a yen story. It's very much about a global macro story where you do have a war going on in the Middle East. You do have inflation fears, spiking treasury yields, and we know that the dollar dominates in this environment, and people do flock to the dollar generally for safety. So if you've got higher treasury yields, rate differentials do matter. So would you rather put your money in a dollar where, it's more higher yielding, it's safer as well? Or do you want to put your money in the yen, where you know that there are inflation problems in Japan, questions around the BOJ's policy path, and for many investors out there, the answer is simple. You sell the yen, you buy the dollar, you invest in treasuries.
Our Chief FX Rates Asia correspondent Ruth Carson there with all of the moves in the FX space. And of course, we'll be following the Aussie dollar, as we mentioned as well, with that third rate hike expected from the RBA. You can get more on that decision. TLIV Go is your function for the latest updates, plus commentary and analysis from our expert editors. More ahead, this is Bloomberg.
Let's take a quick look at how commodities are tracking. Of course, top of the pile, crude prices. Look at Brent crude in the middle of your screen there. Unsurprisingly, jumping up 114.44 a barrel is where it last traded. This is after Project Freedom, as it's known, hit a bit of a snag. 2 US-flagged vessels did get through the Strait of Hormuz under military escort, but it was eventful. 7 Iranian fast boats were fired on. We understand that a South Korean container ship was also fired on. So tension in the Gulf pushing up those crude prices. Gold suffering a little. It's down 4,521 an ounce now, finding it pretty hard to compete with these elevated yields that we're seeing. Let's have a look at the top global headlines that we're following. Indian Prime Minister Narendra Modi's BJP has won an historic landslide in West Bengal state, ending 15 years of rule by Chief Minister Mamata Banerjee. The win underscores the BJP's broadening support base beyond traditional strongholds in the north and west, and the victory gives Modi fresh momentum to advance his political and economic agenda. Japan's military will reportedly expand the test firing of missiles and other advanced weapons in Australia under agreements reached during Prime Minister Sanae Takaichi's visit to Canberra. The two leaders also signed 4 separate agreements, including statements on defence, energy and critical minerals. This is Bloomberg. Let's take a look at how Australian futures are tracking. A little bit softer at the moment. We're off to the tune of 0.8%. The Aussie dollar pretty strong, though. One of the few currencies that we've seen appreciating since the outbreak of the war in Iran, and possibly getting a tailwind as well from an anticipated rate increase from the Reserve Bank of Australia. That decision due in 5 hours' time. It will be the 3rd in a row. Also, we'll be watching shares in Australia's biggest lender, Westpac, after it posted a first-half profit that fell short of expectations. CEO Anthony Miller warned that the war in the Middle East is weighing on customers and adding to economic uncertainty. Let's get to Bloomberg's Australia finance reporter, Richard Henderson, now for more. Joins us here in Sydney. Good to see you, Richard.
Good to see you.
What's behind this profit miss?
So basically, these are quite resilient results, I would say. It's not a big miss, but definitely we're starting to see the effect of the volatility in the market, higher fuel costs impacting some of the borrowers, business borrowers, consumers. That's starting to feed through to these results. We're also in the middle of a sort of shift into AI among the big banks. They're all trying to figure out how to integrate, and so we're seeing some charges, some costs with how they're valuing their old software. So that's playing into this a little bit. But broadly, fairly robust results, but just missing on the profits there.
So where are we seeing any signs of stress, like, for example, company lending, and how is inflation feeding into that?
This is a really critical point, and the big banks really offer a bird's eye view into the economy because they're lending to small, medium, large businesses, and the CEOs are all, we've seen 3 of the big 4 reports so far, the CEOs are all saying pretty much the same thing. There's a lot of fear out there. There's a lot of stress making its way into the system. Inflation is a big problem. Higher fuel costs, really for logistics, for transport companies. It's a massive, massive charge for them. And so we're starting to see that stress filter into to the economy and impact how banks are lending to these companies.
And are we seeing any role of AI emerging in some of these results?
It's very hard. I've been watching really closely because I think it's such a critical point for all businesses. Really, all of us are trying to figure out how to use AI. In terms of practical use cases, we don't see a whole lot of detail. We see a lot of enthusiasm, a lot of experimentation, but not actual wins on the board. Different banks are at a different stage in the journey. Commonwealth Bank would be seen in the market as quite aggressive with its investments in AI. They have a special partnership with Anthropic and an undisclosed investment in Anthropic, which is behind the Claude chatbot. But in terms of real-world use cases that are starting to improve the operational, work of these banks, we're not quite seeing much detail on the use cases.
All right. Bloomberg's Australia finance reporter Richard Henderson there. Shery.
And Paul, let's stick to some of the top developments around tech. UPS and FedEx shares tumbled after Amazon launched a new bundle shipping service that may threaten their core business. Amazon Supply Chain Services gives businesses access to its freight and distribution network, bundling air, ocean, trucking, and last-mile delivery into a single service. The company originally built the network to support its own website, but it's now expanding it to outside customers. Palantir Technologies has raised its revenue outlook for the year to almost $7.7 billion, far exceeding analyst estimates. Sales in the first quarter rose to a record $1.63 billion, but U.S. commercial sales fell short of expectations. Palantir's long-running deals with the U.S. and foreign governments now faces growing competition from rival tech companies. The Trump administration is reportedly considering an executive order to create a working group on AI. The New York Times reports the proposal could introduce government reviews of new AI models and resemble a framework followed in the UK. The report says White House officials briefed executives from Anthropic, Google, and OpenAI last week on some of the plans under consideration. Bloomberg's been told that OpenAI and Anthropic are both forming joint ventures with financial firms to accelerate adoption of their AI tools. OpenAI has raised more than $4 billion from TPG, Brookfield, Advent, and Bain Capital. Meanwhile, Anthropic is partnering with firms including Blackstone and Goldman Sachs. Boosting adoption rates has become critical for the two firms as they target IPOs. You can get more on the biggest stories in tech on the Bloomberg Video Hub. You can check out past episodes of Bloomberg Tech Asia and other shows on Bloomberg.com/videos. And coming up, we take you live to the Milken Institute Global Conference for our conversation with the Starwood Capital CEO. More ahead on the Asia Trade. This is Bloomberg.
risk to both of our mandate goals has increased. The elevated levels of inflation, mixed signals from the labor market, and heightened uncertainty from the Middle East conflict present an unusual set of circumstances. But the current stance of monetary policy is well positioned to balance the risks to our maximum employment and price stability goals.
That's New York Fed President John Williams speaking there. Let's take a look at how futures are tracking at the moment. We do have a few markets closed around the region today. There will be no trade in Japan, South Korea or China, but we do have Nikkei futures trading out of Chicago. No change at the moment, however. We are setting up for some losses in Australia when we get the open at the top of the hour. Futures currently off by about 0.8%. The yen, an interesting one as well, Shery, as we keep asking questions over was it or wasn't it intervention and how much more could be on the way.
Yeah, especially since Japanese authorities have declined to officially comment on whether intervention took place. But according to Bloomberg calculations, that was worth more than $30 billion. In fact, what's interesting is that Goldman Sachs has come out with a figure saying that they actually have capacity for 30 interventions at around $31 billion if needed, that they have plenty of foreign reserves totaling more than $1 trillion. You can see the Japanese yen holding at that 157 level against the U.S. dollar. But after spiking towards that 155 level. And of course, we do have the Japanese market, the Chinese markets, also South Korea away on holidays. But we're really going to try to digest the latest coming from the ongoing war in Iran, especially since we've now seen, Paul, the U.S. and Iran exchanging fire in the Persian Gulf and then crude prices just jumping. We're talking about Brent nearing that 4-year peak with tankers being hit near the UAE's Fujairah port. Very important given that even Secretary Besant is saying that global oil shortfalls would amount to up to 10 million barrels per day. And this has, of course, very big implications for the trajectory of inflationary pressures. So not surprising, we saw treasuries just selling off in the overnight session, Paul, with 10-year yields now above 440.
Yeah, it was certainly an eventful few hours in the Gulf as so-called Project Freedom made its first attempt to get a couple of vessels through the Strait of Hormuz. Two U.S. flagships did successfully make it through, but not without incident. They were under military escort. It's understood that 7 Iranian fast boats were also fired upon by U.S. military ships. Also, a South Korean vessel reportedly coming under fire as well. But the president and Scott Bessent also trying to encourage other nations to now get in position or be willing to join the effort to reopen the strait. Doesn't seem to be a lot of enthusiasm for that, though, at the moment, Shery.
Yeah, even Secretary Bessent urging China to support the operations by the U.S. in the Strait, right? Saying that China buys about 90% of Iranian oil. And of course, we are headed towards that mid-May summit between Presidents Trump and Xi Jinping, which was delayed earlier because of the war. In the meantime, we're 3 months into this ongoing conflict in the Middle East. We have seen the first attack on the UAE in almost a month, and the implications for the markets, as we mentioned, are pretty huge at a time when treasuries are selling off. And even the Fed seems to be pretty split on where to go from here. You were talking about the Fed's William, talking about rates. Well, we also saw from the Dallas Fed just this week, Lori Logan saying that the Middle East conflict raises the risk of a prolonged supply disruption and further inflation pressure. We have more ahead. This is Bloomberg. The annual Milken Institute Global Conference is underway in Beverly Hills, bringing together some of the biggest names in finance and investing to discuss the shifting global economy. Let's cross over to the event where the close co-anchor, Romain Bostick, is with our next guest. Romain.
Hey, thank you, Shery. I'm here with Barry Sternlicht here at the Milken Conference in Beverly Hills, the CEO and chairman of Starwood, who, of course, made his name turning around hotels. You created the W, you got acquired the Sheraton, you did a lot more. But you made a little the Westin. We can go on and on. You were like the hotel guy for a long time, and I guess you still are.
I was a real estate guy before I was a hotel guy.
Okay, all right.
Now I'm back to being a real estate guy and a hotel guy.
All right,
we have started hotels again.
So you started hotels again, but you've broadened out. I mean, I'm looking at some of your investments lately. Yeah. You're doing a lot right now in the sort of AI, data center infrastructure business. That's become a huge component of your business, isn't it?
It has recently. I mean, for the last 5 years, we've been doing data centers.
Yeah.
And we started really in the Dulles market, the largest data center market in the world, 8.5 gigawatts in place. And Dulles was the home of the internet. And so there's great connectivity. And it's sort of ground zero. It's like Park Avenue and 57th Street.
Yeah.
And then we've broadened out to other markets. We did a deal with a Bitcoin miner.
Yeah,
and
with Mara Holdings, right?
Mara Holdings, and we're looking at others, and then we're expanding to other states. And we've with 2 platforms we've launched into Europe and into Asia.
Yeah,
both directly and indirectly. In Europe, we have the largest data center operator. We own the majority interest in largest data center operator in Ireland, which has expanded a joint venture with the Spanish utility, Iberdrola. And then we've also got sites in Milan. And then in Asia, we bought, together with Warburg, a controlling interest in ESR, which is Asia's largest real estate asset manager. We took it private last year. And they have a big data center business. And then on our own, we partner with them, with ESR, but also have moved into Australia. And we're looking in Japan and Korea also. And we've been in and out of Malaysia. We haven't bitten the dust yet. But I don't know if bite the dust. I don't think that's the right word. Bitten the bone?
The bone. We'll talk about ESR, because ESR is pretty expansive. I mean, that includes South Korea, Japan, India. I'm probably forgetting a couple of nations in there. That gives you a pretty broad footprint there. Why did you lead that deal?
We like their footprint in the new world. They're leaders in logistics, the largest or second largest neck and neck on logistics, with a huge footprint in Australia, which is a super healthy market. We did a large investment into Sydney and Melbourne in industrial a year and a half ago. And also, we like Japan. You know, it's done great with their abandonment of the yen and the fact that they've become so competitive while letting the currency go. So ESR has had a really good footprint in really the fast-growing countries, and we think Korea was distressed, but coming out of that. They're great developers. They've done some great development deals all across Asia, including India, and they're about they were 150 billion. We're shrinking them down to about 120 billion of AUM, assets under management. We're about 130.
Wow.
And we're long, as a firm, more Europe and the U.S., and they're long Asia, so it was complementary to what we were doing.
Yeah.
And we're working with a group of investors. We took it private. It was I think it was the largest privatization in Asia last year.
It was, yeah.
So I think
would you have done that? I mean, you mentioned Japan and obviously the big changes that we've seen in the yen and fiscal policy over there. Would you have done a deal with such close ties to Japan, I don't know, 5 years ago, 10 years ago like this?
I think those two asset classes have caught the favor with investors, and a lot of their clients are sovereign wealth who invest with us. So we could do diligence to how they felt about ESR as a manager. And ESR was a sort of a funny company. It was listed on the Hong Kong Stock Exchange, but didn't really pay a dividend. Most asset managers pay dividends, and they grew at hyper speed. And so the markets then they had a lot of exposure to China. We think we valued that market appropriately, but they're a big logistics player in China. It's one of probably the weakest logistics market in the world that I'm aware of. And but I think we valued it well below book, and we bought the company, I think, attractively. We put together a consortium that includes some of the original shareholders, just rolled over into our privatization. And then we put, a really good group, including some of those sovereign wealth funds, joined us in the take private. So it's going really well. I've rarely done a consortium deal. We're doing deals by ourselves, maybe one partner, but there are 5 of us invested. But we've all agreed on the business plan up front, and we're executing. Yeah. And the team's good and focused, and I hope we can grow it dramatically and then re-IPO it.
What about the Telstra deal in Australia? I mean, how important is that market for you right now?
Australia is a good market. Yeah. There's trunk lines from the U.S., and there's no data sovereignty issues. I think both in Europe and Australia, and to some extent all of Asia, we've seen the hyperscalers who are really focused on the U.S. In the last 6 months, they seem to be really focused on moving out and not abandoning the U.S., but they're much more active in Europe. They're much more active in Asia. And we're working right now on our first real data center deal on our own in Australia.
Are the economics and the valuations a little more attractive there relative to, say, what we're seeing here in the U.S.?
No.
No?
The same.
Really? Oh,
yeah,
wow.
Pretty much the same.
Yeah. Is there more upside, maybe? I mean, why chase that? Why not just continue, roaming around the U.S. and try to
if you can get power anywhere in the world, you have something you can talk to a hyperscaler about. So we're just agnostic. Yeah. And, the interest rates are about the same in Australia as they are here. Yeah. And the yields on cost for us developing are about the same. And the equipment costs the same thing, and we have equipment problems everywhere. It's not just the U.S. You got to order your turbines and your chillers and your other equipment, and the labor seems to be okay. It's not. It's really Melbourne and Sydney, pretty much. It's not. It's not across the country. And our partnership with Celestra is a great help, and they've got sites, and we're working on one of them. Hopefully, we'll get it done very shortly.
What about your footprint in Europe? Because that's been expanding too. In fact, it seems like you're putting a little bit more emphasis on that than some of the other regions.
Well, for real estate guys like us, we like to invest with positive leverage, when the yields on property are higher than the cost of debt. And that turned true in Europe a lot faster than the United States. So we just took private, we bought a Swedish home builder. We thought that market was interesting. It's undersupplied. We have a huge owner of industrial in northern Italy, which is that's a good part of Italy from an investment standpoint, and the south is not so hot. But that enjoys a 2% vacancy rate. We're seeing growing rents, and we're getting inbound interest to buy the stuff. We've been very constructive on take privates of small public companies in Europe. There are a lot of small REITs in Europe that can't get to scale. And they were quicker to actually, let's say, clean the books, or shareholders got stuck and wanted to sell a company. So we continue to comb through the public markets looking for things to take private. There's a couple companies working on right now. And I think really more on the continent than the UK, because rates are higher and the economy stayed stubbornly weak. I'm not really worried about the European economy going into a deep recession. It's interesting. We have a footprint in Germany with a very large developer, and everything they touch, everything they open for lease, immediately pre-leases. Yeah. So we just achieved the highest rents we think ever in Berlin on an office deal we're building. So it's I think those markets are inherently better than the markets in the United States in the sense that the vacancy rates are much lower. Yeah.
Have you given up on the United States?
Not at all.
No?
Not at all. We're just waiting for Kevin Warsh to bring rates down for us.
You think Kevin Warsh is going to do that? Let me rephrase it. You think he's going to have a reason to lower rates?
Well, I'd argue if oil spikes, he should lower rates. Because oil...
That seems counterintuitive.
Because interest rates aren't going to affect oil prices, right? But on the other hand, oil prices are a tax on the U.S. and the global economy, weakening the economy. So he should lower rates and help the interest rate sensitive parts of the economy, like housing, to balance the economy and keep it going.
How much room does he even have to do that? I mean, a quarter point isn't going to do anything for anybody.
I think the short end could be 3.
Really?
Oh yeah.
Wow. Okay.
It was 3 before the war. The forward curve was.
It was 1 at one point.
It was 1. No, I mean, like 6 months ago, it was in the fall, it was 3, the forward curve. And I think the U.S. economy is sort of a weird economy. We talk about this GDP growth and the exceptionalism. That's true from the AI's perspective, from the consumer's perspective. He's not doing so great. Half of this country is sort of not doing so great. And they're facing higher everything prices, particularly gas now. And so if the U.S. is a consumption economy, you would expect consumption to get weaker. Yeah. And we'll see if it happens. You're already seeing changes in travel patterns. Americans aren't going to Europe this summer. Yeah. Travel to Europe's down like 10% from the United States.
Does that worry you, though? I mean, that some of these changes aren't just temporary, that they could be long-term structural shifts?
No, I don't. What worries me is, yes, the disparity of wealth in the United States and the fact that half the country isn't doing so great. That worries me. That because it will impact politics, and if it impacts politics, it'll impact real estate, it'll impact taxes, it'll impact a lot of things. Yeah. So I think as investors, we've shied away from blue states lately because of their propensity to tax businesses and individuals, and that's showing up in higher growth rates in the Sun Belt states, which are oversupplied in the United States, but that's where the job growth is, and eventually they will grow into their supply. There's not a lot of new supply, where some of the blue states are losing jobs, and they don't have a lot of supply, but they won't, 5 years, 10 years from now, they won't be outperforming the Nashvilles, the Dallases, the Atlantas, the Raleighs, pretty much the entire state of Florida.
All right, Barry, really appreciate it. We have to leave it there. Barry Sternlicht there, the chairman and CEO of Starwood Capital. Back to you in the studio, Shery.
Yeah, thank you so much, Romain Bostic there, joining us from Los Angeles. And of course, we're setting up for the market opens across Asia. This is what we're looking at. Watch oil, because under a little bit of pressure early in the Asian session, but after surging in the overnight session, we heard about U.S. and Iran ships exchanging fire in the Persian Gulf, not to mention that the UAE's Fujairah port had been attacked by Iran, according to reports. So Brent prices now near a 4-year peak. That's really leading to repricing of inflation risks. And you can see Treasury yield surging. The 30-year yield has surpassed 5%. You can see the 10-year yield now past that 440 level. That's linked to dollar strength as well. On the other side of that trade, of course, you have all of the Asian currencies, including the Japanese yen. And we're watching the yen very closely after what was likely intervention by Japanese authorities just last week. Take a look at the setup for the market opens in Australia. Japan away on holidays, South Korea away on holidays, China also away on holidays. So we're talking about thin liquidity. Still, really yen traders watching for any intervention moves after the yen spiked towards 155 just a few hours ago against the US dollar. We're still sitting at that 157 level. But big day for Australia. The RBA could hike for a third consecutive month. Plenty more to come. This is Bloomberg.
This is the Asia trade. We're counting down to Asia's major market opens. There won't be too many today. Some of them are going to be closed, as we'll get to in a moment, Shery. But of course, it's all about the oil price again. Project Freedom to escort ships through the Gulf of Hormuz, the Strait of Hormuz, getting off to a rocky start.
Yeah, we have seen the U.S. and Iran exchanging fire in the Persian Gulf. And as you said, Brent near a 4-year peak. But thin liquidity just means perhaps exaggerated moves in the markets, which we'll have to keep a close eye on.
Yeah, well, we're just a few seconds away from the open here in Australia. Going to be a big day as well, because the Reserve Bank of Australia will hand down a cash rate decision in about 4.5 hours' time. Markets are pricing in another 25 basis point increase, but we will see. There is a chance that it may not occur. Ahead of that decision, though, we've got assets looking like this. We've got the ASX off by about 1/3% right now, as you might expect. Not quite as bad as futures were predicting, however. Westpac Bank down 1.7%. We often see this when the big Australian banks are out with earnings. The first half result from Westpac was a miss, although we did see first half profit up 3% to $2.4 billion. The bank warning about this ongoing impact from the rolling war in Iran, saying it's going to impact customers, energy costs, inflation, rate rises. However, lending did still grow despite that backdrop. The Aussie dollar one to watch as well, 71.67. We'll see if that moves later on today when we get that RBA decision. But at the moment, Shery, one of the few currencies in the world that's appreciating under these circumstances.
Yeah, we're talking about 4-year highs, right? Given, of course, the rate expectations. On the other side of that trade, you have the U.S. dollar also gaining some ground in today's session. This all to do with inflation repricing as well. Of course, we have talked about crude prices now under a little bit of pressure early in the Asian session, but only after Brent is now nearing that 4-year peak. We're talking about 50% gains since the Iran war started about 3 months ago. What this means really for Treasury yields, inflation repricing, pricing is a key question. You have the 10-year yield now past 440, the 30-year yield topping 5% as well. So with dollar strength, you're watching everything on the other side of that trade, especially the Japanese yen. Yes, we had a little bit of a spike in the overnight session towards 155. Of course, we are very much on intervention watch after we saw what happened last week, which was likely intervention. Authorities haven't necessarily confirmed this, but Bloomberg analysts now saying that that was potentially more than $34 billion spent, although Goldman Sachs is saying, you know what, around $30 billion, you could do it around 30 times. You can see the Bloomberg Dollar Index not doing much. U.S. futures, they fell from record highs in the overnight session. We're still watching the tech sector around the AI narrative, but let's bring in Kyle Rodda, senior market analyst at Capital.com, for a check of what to watch on very thin liquidity this week, Kyle. But given, of course, where we're at, does it surprise you that we're not seeing bigger moves, especially in the equity space, when you have the 10-year yield past 440, you have oil past $100 a barrel?
Perhaps not surprising because, I think the narrative has quite rightfully focused on such strong earnings growth in the United States, and that's had that kind of proverbial effect of lifting all boats. But what I think can be said is that the market is very sensitive here to downside surprises, specifically because the markets have taken this glass half full approach to the conflict in the Middle East, which could easily escalate in the worst case scenario, or if nothing else, even in the best case scenario at the moment, still see the Strait of Hormuz shut and energy markets remain very, very tight. And of course, we're heading to that proverbial supply cliff that could see things get a lot worse from here. So I think in the short term, there's a risk that we see the narrative shift now back to the war, that markets are in a position where confidence is pretty high after such a strong earnings season, and we might be poised for a bit of a pullback in equities as a result, especially cyclicals, and then a bit of a bounce in the US dollar, a drop in gold, basically a reassertion of those war trades from back in March.
Yeah, and Kyle, what happens when the narrative shifts towards a hawkish bias from central banks? I mean, we are expecting the RBA to hike rates for a third consecutive meeting, but even when it comes to the Federal Reserve, markets now pricing in a 70% chance of a Fed rate hike by April next year instead of a cut. So what would this mean for the markets?
It would be really negative. And I think, again, if you look at the situation last week, which I think offers a really great microcosm for where we are at the moment in the markets, we had policy makers making decisions, we had earnings, and we had geopolitical risk. Really, geopolitical risk got worse. Policy uncertainty probably picked up at the margins, although I do think that the reassurances from a lot of central bankers that they're inclined to look through this supply shock has had an influence on maybe settling nerves and maybe supporting sentiment at different stages over the last 6 weeks. But what really held it all together is this extraordinary earnings growth in the United States, this sort of 27% earnings growth that we're expecting for the S&P 500 for the quarter, really holding it all together. But again, if we see the narrative change when it comes to the situation in the Middle East, that complacency giving way, and then all of a sudden this realisation, perhaps from policymakers and therefore the market participants too, that maybe there might be rate hikes coming down the line, and even if they aren't necessarily assured, that the possibility means that uncertainty picks up. It is that kind of atmosphere where you start to see a little bit of a re-rating in the markets, especially after such an aggressive move higher in risk assets. And this kind of narrative that's re-emerged of this kind of Teflon market that can kind of, shrug off these things just because of strong profit growth. So it's just a precarious situation where, again, from a tactical perspective, I think there's downside risk in risk assets.
Kyle, from a political perspective, there's certainly motivation to get the Strait of Hormuz open because we're 6 months away exactly from the midterms in the United States. So can we assume that it's probably going to happen within those 6 months? And when it does, what sort of reaction would you anticipate from equity markets, considering they're already looking through the risk anyway?
Well, I think that's the problem, is that the markets are making that bet that it's in the United States' best interest because of the domestic political situation to make a deal, that it's in the best interests of some in the Iranian regime to make a deal. But the problem is that there is often in these situations inertia that drags even the best intentioned actors in a crisis towards potential conflict, especially now that we see that there's significant differences in terms of the Iranian enrichment program, there's significant differences around the Strait of Hormuz. You can end up in this kind of race to the bottom. Another thing that is worth noting too is that the domestic political situation in Iran, I think, is being underappreciated, especially the real strong desire, as is historically typical of the hardliners in in Iran to try and continue to fight this war and effectively assert its dominance in the region. So it all means that despite the fact that clearly there is strong political incentives in both Iran and the United States to resolve things, and that's what the markets are betting on, that isn't rest assured. And the fact that, again, the markets have pretty much placed their bets that this is going to be the outcome, it raises the risk of a fairly significant downside move if the worst case scenario emerges and we see an escalation, which again is possible and might be just a matter of effectively strategic inertia, military inertia, dragging us to that point.
Can you also share with us your thoughts on what we've seen on currency markets recently, particularly regards the yen? Pretty obviously, well, there's a lot of speculation that we've seen intervention from the Ministry of Finance, but is it becoming pretty clear to you where the thresholds are and the sorts of things the Ministry of Finance is willing to do to protect the yen?
Without a doubt, 160 is a level. I think everyone sort of knew that before this, and when we did see that level breached at the back end of last week, as a maybe slightly more hawkish Fed, oil prices creeping higher, all these things that were weighing on the yen, probably slightly dovish BOJ relative to the Fed. 160 got breached, and everyone was waiting for that intervention. The problem is, at least for policymakers over there, is that they want to run, effectively a run-it-hot policy with both fiscal fairly loose, monetary policy remaining behind the curve, and by the BOJ's own logic, in accommodative territory. So the problem is that a little bit like the beach balloon being held underneath the water, the yen's going to continue to depreciate. The US dollar is going to continue to rise anyway for fundamentals completely separate from Japan, and that means that there is going to have to be very strong interventions periodically from the Ministry of Finance until the BOJ strengthens its line and gets a little bit more muscular with monetary policy. So it's a very, very difficult market to trade, but I suspect it will continue with everything assuming everything remains the same at the moment with the political situation in the Middle East, monetary policy in the United States, economic conditions in Japan, that the yen will err towards downside pressure. And all that means is that 160 level is absolutely crucial, and we'll probably see on any breach of that level, especially if it's rapid, an intervention from the Ministry of Finance.
Yeah, the yen definitely not acting as a safe haven asset these days. But what about gold? I mean, we had seen the geopolitical risks really support the bullion, but we are now seeing inflation risks perhaps erode that?
Yeah, it's a mechanical issue here, and that's, of a higher US dollar. There's a number of reasons for that. Interest rate differentials, the trade situation, and US energy independence, and then obviously when oil prices rise, that barrel of oil requires a few more dollars to be able to purchase. All those things, plus the inflation shock coming through, lifting yields, is going to have the impact of weighing on gold prices. So I think in the short term, especially where we are now with how things are positioned, gold could be looking at another potential spill back towards those sort of low 4,000s, maybe high 3,000s. I think in the long run, and if gold gets to those levels, it should be well supported, because if we look at this from a structural perspective, this conflict in the Middle East is another example of the kind of multipolar world and the sort of degradation in global institutions and systems that is going to lead to that kind of further de-dollarization trade and that sort of demand for gold as a safe haven in the bigger picture. But once more, in the short term, it's a war trade. It will trade as a function of a stronger dollar and a higher global yields, and that puts downward pressure on the gold price inevitably.
All right, Kyle Rodda, Senior Market Analyst at Capital.com there. Thanks for your time today. And just to illustrate what Kyle was talking about there, let's take a look at how Aussie gold stocks are moving. It's a real-time example of Kyle pointing out its yields versus the gold price at the moment, and yields are winning, just too attractive for the yellow metal at the moment. Northern Star, one of the owner of the biggest open pit in Australia, off by 2 3/4%. The gold price is easing. Gold price in Aussie dollars right now, 6,312, so well off those highs that we saw above 7,500 in Aussie dollars. The materials sector as a whole, the worst performing in Australia at the moment. On the other side of the coin, the energy sector, the best performing on the ASX right now. That sector up 1.5%, and some of those big names leading the way. Woodside Energy better by 2.4% now. Coal miners are also catching a bid. Whitehaven unchanged at the moment, but Yancoal Australia up by 0.4%. We saw oil and gas prices in the US also rising by almost 2%. We have more ahead on the Asia trade. Stay with us. This is Bloomberg. US and Iran have exchanged fire in the Persian Gulf, jolting a 4-week-old ceasefire. Oil prices surged on the back of those attacks. President Trump has since said that the war could go on for another 2 to 3 weeks after downplaying the continued rise in crude.
Can't let Iran have a nuclear weapon. We hit all new highs, and I said we have to take care of business because we can't let that happen. So we did a little detour, and it's working out very nicely. They thought that energy would be at $300, right? $300 a barrel, and it's like at 100. And I think going down, and I see it going down very substantially when this is over, Chris, and I think very rapidly too.
For more, let's get to our senior editor for US economics and government, Derek Wallbank. And Derek, the president there saying it's working out very nicely. Well, it was a pretty rough ride in the Gulf today. The UAE got hit again. The 2 ships that the US military escorted through got attacked. How realistic is this approach?
Yeah, Paul, it was probably the shakiest day since April 8th, since the ceasefire started. So we've really had a bit of time now, nearly a month of a sort of stasis in and around the Strait of Hormuz, where not too much is getting through that critical vital waterway. But at the same point, we haven't had those sort of kinetic attacks by the U.S. and Israel on Iran or by Iran on its Gulf neighbors. So you have had sort of like a steady unease, steady truce while we've had these negotiations going on. But obviously there was an escalation. Now the U.S. has said that it wants to open up the Strait of Hormuz. It has suggested that other countries ought to get involved in so doing. Hasn't really found any takers for that. So the U.S. was trying to get through some boats. Those came under attack by Iranian forces. We also saw the United Arab Emirates having to intercept some Iranian missiles and drones. And so you are seeing a bit of a shakeup there. What I have found is interesting, though, is that given the chances in the Asia overnight in the U.S. day to sort of declare that there was a ceasefire broken and to declare that there was, a bigger resumption of hostilities, President Trump did not take the opportunity. So there is some suggestion right now at this hour, until we see otherwise, that the U.S., at least rhetorically, has been trying to keep this on the rails.
Yeah, and we had some remarks from Iran's foreign minister as well, saying there's no military solution to a political crisis, which is more conciliatory than what we were used to in the earlier days of the war. So what's the current state of play with the diplomatic approach?
Well, the diplomatic approach is in quite a difficult situation, Paul, in part because, the red lines are very different, right? Iran has said that it's not going to give up its nuclear ambitions forever, and Donald Trump has said that Iran can never have nuclear weapons and has made Iran giving up its nuclear ambitions a center point to any idea of a full stoppage here. So those 2 points exist in conflict, right? You can't sort of find a middle ground there. But the question is going to be, is this situation going to escalate, or are we going to get back to a point from which there could be discussions about where these off-ramps are? Look, Donald Trump is supposed to go to China at the end of next week to have meetings with Xi Jinping. China has some sway with Iran. You would imagine that Iran will be a subject of those meetings as and when they happen. So there are some things at play there. Certainly, I think the entire world is looking to whether or not the Strait of Hormuz reopens, and if it does, in what condition. Iran has a much stronger hand now than it did before the hostilities started in terms of what gets through the Strait of Hormuz, which again, right now is not much, but Iran sees an idea that it could permanently have a bigger function there. All of this stuff is sort of, very much in play. But the biggest question right now, Paul, is whether or not this is a point of escalation or whether or not both sides can kind of keep this on the rails, keep this contained, and get back to the table.
Our senior editor for U.S. economics and government, Derek Wallbank, there. And Now we're also hearing from Treasury Secretary Scott Bessent calling on China to join U.S. operations to escort ships through the Strait of Hormuz. Let's bring in our China correspondent, Min. So Secretary Bessent making this demand even as he says the U.S. has total control of the strait. Now, more than 2 months into the conflict, how likely is it that Beijing would jump in now?
Yeah, as you said, more than 2 months in, Beijing hasn't agreed before, so it's unlikely that it will change its stance anytime soon as well, because Beijing is nothing if not consistent when it comes to its stance on this war. It repeatedly says that it doesn't want to get involved, that there should be a political and peaceful solution to the end of this war. It's unlikely that it will send any naval assets to the region in a move that could potentially provoke further escalation, especially what happened overnight with Iran resuming fire and attacks in the Gulf region after the U.S. sort of declared this Project Freedom, and Iran threatened that any U.S. ships approaching the strait could be attacked. And so China is unlikely to do so. This comes as the U.S. also called on South Korea to join the mission after a South Korean ship got shot by Iran as well. President Trump saying that that ship was not escorted, and so it's time for South Korea to join the mission. But again, South Korea as well, the defense minister previously has said that dispatching a warship to the region to act as an escort, that is something that requires parliamentary approval. And again, looks like for now, no takers from Asian allies of the U.S.
Yeah, very challenging position for a lot of these countries. But when it comes to China, President Trump has said that he's looking forward to next week's planned summit with President Xi Jinping. So this is finally happening.
Well, according to the U.S., the signs are that this is perhaps still going to happen, at least from what President Trump is saying. He's saying he's looking forward to the trip, that it is going to be a very important one. But bear in mind, we haven't gotten official confirmation from the Chinese side about whether or not this summit is happening and what dates is going to take place, even though last week we did have those phone calls between Scott Bessent and the Chinese trade representative He Lifeng, which suggests that talks are ongoing to prepare for this potential summit. Last week as well, there was another phone call between the trade ministries. You have the Chinese Foreign Minister Wang Yi speaking with Secretary of State Marco Rubio, and they were discussing issues from economic and trade restrictions to, all the other things on the agenda here. But of course, it's happening under the shadow of this Iran war. And clearly, the latest escalation is that the U.S. has now imposed sanctions on these Chinese oil refiners for buying oil from Iran. And China responded by calling on its companies in China not to abide by these sanctions in the first application of this anti-foreign sanctions law that it put in place in 2021, precisely to push back against these sort of what it calls long-arm jurisdictions. So again, Iran in focus, the other long-standing issues like Taiwan and trade issues also in focus, soybeans as well, especially as we see soybean futures hitting a near-term high, the highest since mid-March, over anticipation that maybe China could purchase more soybeans from the U.S.
So plenty on the table if these two leaders do actually meet next week. Bloomberg China correspondent Min Lo there. We have more ahead on the Asia trade. This is Bloomberg. Palantir Technologies has raised its revenue outlook for the year to almost $7.7 billion, far exceeding analyst estimates. Sales in the first quarter also rose to a record, but U.S. commercial sales fell short of expectations. Let's get more on this with Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh. Mandeep, Palantir has been down, almost 20% this year already, caught up in that software sell-off. What does the market reaction right now tell us about the results so far?
Yeah, another beat and raise quarter, very strong results. The only problem that Palantir has is it used to trade at 80 times, enterprise value to sales. Still, it's trading at probably the highest multiple when it comes to all the software names. And, when you see a sequential deceleration in their commercial backlog, it grew 21% last quarter. This quarter, it was 12%. That's not enough to, drive up the stock price. So really, all in all, very strong quarter, but it's a function of where they are with their valuation.
Yeah, and as I mentioned with the software sell-off, how does Palantir stack up in this world of LLMs?
Yeah, so when you try to unpack why that commercial segment decelerated slightly, it could be attributed to companies leveraging these large language models like Anthropic and OpenAI and really using the token consumption to create custom software where you don't have to use Palantir software. And look, Palantir had a great quarter with the U.S. government. That part actually accelerated, partly to do with, the Middle East war situation. But overall, they seem to be doing very well on the government side. It's the commercial side where you're starting to see the LLMs really pose some competition. And that could be a function of why, that commercial segment backlog decelerated slightly.
Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh there. The top corporate stories that we're tracking: UPS and FedEx shares tumbled after Amazon launched a new bundled shipping service that may threaten their core business. Amazon Supply Chain Services gives businesses access to its freight and distribution network, bundling air, ocean, trucking and last-mile delivery into a single service. The company originally built the network to support its own website, but is now expanding it to outside customers. Bloomberg's been told that OpenAI and Anthropic are both forming joint ventures with financial firms to accelerate adoption of their AI tools. OpenAI has raised more than $4 billion from TPG, Brookfield, Advent and Bain Capital. Meanwhile, Anthropic is partnering with firms including Blackstone and Goldman Sachs. Boosting adoption rates has become critical for the two firms as they target IPOs. The Trump administration is reportedly considering an executive order to create a working group on AI. The New York Times reports the proposal could introduce government reviews of new AI models and resemble a framework followed in the UK. The report says White House officials briefed executives from Anthropic, Google and OpenAI last week on some of the plans that are under consideration. We have more ahead on the Asia Trade. This is Bloomberg. Okay, we've got some modest losses on the ASX in the early going. We're about 30 minutes into trade, off by a little more than 0.5%. Materials the worst performing sector, but energy doing pretty well after the tension escalated in the Strait of Hormuz. Brent crude prices gaining, now 113.88 a barrel, but the broader index weaker. The Aussie dollar holding up pretty well. And of course, it's a big day. We've got a Reserve Bank of Australia rate decision in 4 hours' time, and the expectation is we will see a third consecutive increase. Well, let's get to our next guest, who does expect another split RBA board decision and doesn't think a rate rise is necessarily a done deal. Joining us now is Diana Mousina, Deputy Chief Economist at AMP. Diana, thanks as always for joining us. So can you state your case for us? Why could this not be the sure thing that we anticipate?
Well, my base case is that we still get the rate rise today, but I think the board's going to be split again, mostly because we saw a split board last time the RBA met in March. 4 members voted to keep rates steady. And in this meeting, we just received the March quarter inflation data, and that was actually a little bit below the RBA's expectation. So I think that maybe some board members will think that there's no need to rush and raise rates at this meeting. Michelle Bullock, the governor of the RBA, told us last time that it was more of a question of timing rather than direction for the board members that decided, or for the members that wanted to keep rates on hold. And that may be the case this time as well, because the inflation data looked a little bit better. And of course, we've still got this conflict going on in the Middle East, which has the potential to derail sentiment in the next few months. I mean, it has to some extent already, but markets are sort of pricing in that the conflict's more or less going to go away soon. But that is still a risk that the board has to keep in mind.
Yeah, in terms of your expectation that we do see tightening today, we do have a chart on the Bloomberg terminal that illustrates, so many assets are protecting this. The Aussie dollar, the 10-year yield, inflation, all seem to be pricing a rate increase. But before conflict broke out in the Gulf, Australia had a problem with sticky inflation anyway. How many more increases do you see in this cycle? If we get one today, is this the end of it?
We may see another one, and our base case is, we've penciled another one in potentially for August, based on our inflation forecasts at the moment. Like you said, the domestic inflation picture wasn't particularly rosy in the past 6 to 9 months in Australia. We've still got very high inflation in things like rents. We've seen new construction costs start to pick up. Medical and hospital costs are still elevated. Food price inflation is high and has been so for the past 12 months. And then we get this additional increase from the flow-on effects of high oil prices, which is not just leading to high petrol and diesel costs, but also into services, into agriculture and into food. And if we see more businesses pass on the so-called fuel surcharge, then inflation could even go above our forecast. So that's why we think the Reserve Bank's going to be still cautious in the next few months and talk up the risk of potentially needing to hike again. But if we get the rate rise today and potentially another one, say in August, it is hard to see rates moving above that. So basically a peak of 4.6%. If we get anything above that, I think that there may be too much unwanted downward pressure on the economy.
Diana, we're also seeing the growth concerns after the war also hit business and household confidence, right? When you have growth risk looming and we really don't know where the war is headed at this point, what's the risk of the RBA hiking too fast and having to do a U-turn? And this is a central bank that has done this in the past and taken a hit to credibility.
Yeah, for sure, it is a risk. I guess the good news is that we haven't seen too much of a negative blowback to real data because of the war. Yes, we've seen a fall in consumer and business confidence, but consumer confidence has been negative in Australia basically since COVID. And within that time, we've had very strong rates of retail spending, of consumer spending, booms in household wealth. So to me, the confidence data, particularly for consumers, has not really been a good leading indicator like it has been in the past. So I don't really place too much weight on it. I think it does tell us something about how consumers feel about their environment. Cost of living is still a massive concern. But at the end of the day, they're still out there spending. And we get now the weekly bank credit card data, which hasn't really shown much of a dip. And business spending is really driven by what consumers do initially. So for the most part, as it stands right now, yes, we've seen an increase in petrol and diesel prices, but we haven't seen too much of a swing the other way with consumers dipping back and saving more or not spending on those discretionary items. It's definitely a risk, particularly if oil prices go up further, but it's just not the reality right now.
With the dynamics in the commodity space, also with the rate expectations at this point, we have seen the Aussie dollar now hovering around 4-year highs. What are the expectations and the outlook for investment markets at a time when we have seen pretty resilient U.S. markets, but then at the same time we have central banks around the world, including the Federal Reserve, perhaps turning to a more hawkish bias?
I mean, I've been surprised at the resilience in share markets, as I think a lot of analysts have been. I mean, the surge in US shares in recent weeks after the dip is mainly down to the fact that we've had pretty good economic data, we've had booming profit growth, and the March quarter earnings season in the US was incredibly strong. Tech made more outperformance. I think the outlook, to be honest, is still quite positive for investment markets. Yes, we could see another dip in prices in coming weeks if we see that the Strait of Hormuz is not opened, if we see the blockade continuing. But at the end of the day, I think
Diana Mousina there, our Deputy Chief Economist at the AMP. Actually, we have lost that connection, but we were anticipating that rate hike to come from the RBA as the Aussie dollar holds at around that 4-year high against the US dollar. And subscribers can turn to the terminal for more on the RBA decision. TLIV Go is your function. Right, and still to come, insights on what Australian investors should be watching for amid geopolitical turmoil and the rise of AI. Highlights from the Bloomberg New Voices event in Sydney coming up on Australia Ahead. This is Bloomberg.
Goldman Sachs says green shoots are appearing in Australia's subdued deals landscape, which has been lagging Asia and the US. The head of Australia and New Zealand M&A, Marissa Freund, spoke to us at Bloomberg New Voices events in Sydney, alongside Westpac chief economist Lucy Ellis and TAMCAP co-founder Junbei Liu.
It is a tougher environment for M&A at the moment, although somewhat counterintuitively, the US-Asia activity is flying and have actually quite materially delinked from the more muted levels of activity we see in Australia. M&A is a confidence game. People tend to undertake M&A when they feel emboldened by their share price, emboldened by the environment and the performance of their business. And so obviously in a volatile, more uncertain environment, people feel less confident. Now, that's not necessarily how it should work. You should be buying when low and selling when high, but that's not how it always does work. So things are up, but not as up here as they are in the other parts of the world. And why do we think that is? There's a range of reasons. One of them, Heidi, is the one you pointed out, which is when you're doing mergers and acquisitions, what do you have to do? Well, you have to work out what the company you're trying to buy is worth. Quite a challenging or a more challenging task when there's this level of volatility in the world where you don't know what oil prices are going to do necessarily. You have curves, but you're not sure if they're right. You don't know, you don't know what inflation's going to do. You don't know what rates are going to do. So it's a harder task. All that really means, though, is that the bid-ask spreads between buyers and sellers are wider and have to be bridged. What I would say, though, is that this is anecdotal only, but anecdotally, it does appear to have shifted a little bit in the last couple of weeks. There's been a range of announcements, really, in the last 2 weeks, some quite sizable transactions. So one interpretation of that is that the market that I operate in has just said, well, perhaps we live in a volatile world and perhaps that volatile world is going to persist for a while and we can't stop, running our businesses. We can't stop doing things that make strategic sense. So let's just keep going, notwithstanding that environment. And so there are some green shoots that we're starting to see.
Do you think part of that might also be quite often Australian assets are treated almost as a defensive play or a little bit more deleveraged from, for better, for worse, in whatever circumstance you're operating in from the rest of Asia or rest of the world?
Versus other markets? No, absolutely. I mean, this is an attractive market for a lot of offshore buyers to invest in, strong rule of law, really great transparency around our market, great rules around our market to make sure that what people are disclosing, best represents what is actually happening in businesses. And it is, and if you look at the mix of our stock exchange, a lot of banks, a lot of resources companies, probably less tech and SaaS than you see in the US, for example. So definitely, we're definitely a beneficiary of our market being, the mix of it being more defensive than some other places.
Lucy, we've not, in terms of the economic impact, not really escaped unscathed from the energy shock, even though I know we were talking earlier, you were saying the pass-through hasn't quite come through yet, but inflation still remains elevated above the target band. The RBA or any central bank in this environment is in a really tough spot, right? Do you think things are going to get worse from a confidence point of view?
We've already seen a big hit to both business confidence and consumer confidence, and we can see that in all the surveys. In some respects, the petrol price peak hit was actually last month. If anything, that might come back a bit. But what we haven't yet seen in the official data, but we are seeing in sort of non-official data sources like websites of building product wholesalers and, talking to our own customers, the pass-through is happening. So yes, Australian inflation already was above the target ahead of the war starting. This has been an additional impulse. And the thing that's been quite disheartening has been just how much pass-through of fuel prices and transport prices to other prices that we're seeing. And that's inflation, and that's what the RBA is going to have to lean against. And I think it's quite instructive that it's quite hard to find those stories in other countries of, the cafe that's raised its prices or the building products that have gone up 30%. We're not seeing that as much in other countries. So there seems to be some more opportunistic pricing. Costs are genuinely going up, but people are choosing to pass that on. Firms are choosing to pass that on. And that partly is because Australia already had a bit more inflation, or inflation had picked up, so it was already part of the narrative. So that's the bit that the RBA is going to want to lean against. And again, other central banks have pushed back on more hawkish pricing in markets. When markets started pricing in 2 or 3 hikes for the Bank of England and the ECB, the Bank of England governor actually pushed back on that and said markets are getting ahead of themselves. That's not what we're thinking. The ECB is very explicit, saying, we can wait and see. The RBA is not saying that. What they're not saying is just as important as what they are saying. In the RBA's mind, we already had an inflation problem. Now we've got a worse one. And, maybe the reason inflation popped back up last year, in their mind, I don't necessarily subscribe to this analysis, but in their mind, they'll see this as saying, well, that just shows we probably shouldn't have cut rates last year. So this just shows we just need to have higher rates overall in order to squeeze this inflation out and get back to target.
And yet, for all of the economic risks that Lucy's just pointed out, we still have this situation where American exceptionalism prevails in global equity markets. Do you think that that is very much the bifurcation between Mag 7 tech and the rest of the market, which is clearly not in the same space?
Yeah, it's very true, right? So look, I actually think in the next few years we will see incredible amount of efficiency and productivity gain by other sectors, not just IT. We're already seeing it through the tech companies, the Mag 7, and our even local tech firms that are cutting costs in terms of not just the support staff, right? It's core staff, R&D, and everything else. It's not because they decided things are falling, we need to cut our costs. It's not. They find the efficiencies. In the old days, to design a new module, for example, take Westpac, for example, design a new module, it requires 10 people, 250 hours to design one module. And now, with the AI tool, it requires one person, 12 hours. So it's actually efficiency gain. It's not because everything else. Now, this is just a technology sector, and it's happening fast in that space. And I think in the next 2 years, you see it across every other sector. Banks, maybe it's a big one. Australia may not always... CBA has invested a lot, and there's a social license, and you don't just go out and suddenly cut all your costs and everything else. But certainly it makes you more efficient.
That's Goldman's Marissa Freond, Westpac's Lucy Ellis, and TenCap co-founder Jubei Liu. They're speaking to us at the Bloomberg New Voices event in Sydney. And we have more on Australia ahead every Tuesday, 10:40 a.m. If you're watching in Sydney, that is 8:40 a.m. in Hong Kong. Plus, you can tune into the Bloomberg Australia podcast, which delves into the biggest stories shaping the country's role in global business. You can find it on Apple, Spotify, or Bloomberg.com. More ahead on the Asia Trade. This is Bloomberg.
Apollo Management says private credit is the safer place to be as the rise of artificial intelligence is dramatically shifting the investing ecosystem. Co-President John Zito spoke to us at the Milken Institute Global Conference about how valuation frameworks need to adapt to the new regime.
We're in a completely different regime for investing. We're in a completely different regime for how things are going to be over the next 3, 4, 5 years. If you believe in AI, if you are in fact AGI pilled, then the way that you're going to have to invest, the way that you're going to have to underwrite, the way that your entire business is going to have to function will have to shift. And the valuation framework for both public market investors and private market investors is going to have to change. And that's, I think, very exciting. I think it's very exciting for people in the industry who are adaptive and love investing and love seeing around the corner.
It is such a big difference, though, because it used to be an industry that loved asset light, high margins. This requires kind of the opposite of that. So much investing needs to go into that. Is this an industry prepared for it besides the giants, the Apollos, the Blackstones of the world?
Yeah, I mean, look at Intel, for example. Intel for like 10, 15 years effectively was a drag on the entire equity market. And for a decade, they were viewed as the dumb money for actually investing in their infrastructure. And we financed the deal when we financed the deal 2 years ago to finance their fab and to build new chips in Ireland, Everybody hated it. Everyone called us and said, what could you possibly do to invest in Intel? And we got refinanced this year. And the story's not about us getting refinanced. It's about the stock this year, which is up 500%, because the entire world's realizing that instead of wanting to be asset light, maybe it's about being asset heavy. Maybe what before was the rubric for success, it was all about code was the scarce asset, right? Now it's compute. It's data integrity, data quality. It's your talent. What kind of talent do you have? It's all of these things. The whole framework is shifting, I think. I think it's really exciting, but it's not about private or public. It's the whole valuation rubric and how you think about where you want to be in the strategic ecosystem of your business.
So the valuation rubric has changed. Does the industry as a whole realize that, John? Do you think everybody is going to start to have to change their mindset in this way, or is it just a select few that can participate?
I mean, look at what we've been doing. I mean, we're going much closer to the asset. We bought Atlantic Aviation this year. We financed over $10 billion of chips for SpaceX. So GPU financings, power, defense, all of the things that are going to require to grow all the CapEx needs and to go asset heavy is actually the exciting part of private credit, not the old LBO loans that people made and everyone talks about. The actual excitement is investment grade lending for all this CapEx for a lot more asset heaviness.
That's Apollo co-president John Zito there speaking to Bloomberg's Danny Berger at the Milken Global Conference in Beverly Hills. Well, HSBC is due to report first quarter earnings today with the bank's exposure to the Middle East in focus. For more, Bloomberg finance reporter Richard Henderson back with us. So, Richard, what are we looking out for in these first quarter results?
Well, definitely a big focus on the effects of the Middle East war, for sure. I think that, how the bank is dealing with its business customers, the kind of cost increases they're having to pass on to their customers or absorb. And again, Asia is uniquely vulnerable to the fuel issues that we're seeing flow through. So that's going to be a big focus. Banks like HSBC are beneficiaries of the elevated interest rate environment we're in right now, again linked to these inflationary pressures. So that's a good thing for net interest margin, so the money that they can earn on idle cash in client accounts. So investors will be very much on the lookout for that. And then, as always, costs, I think, as well.
Yeah, in terms of costs, how important is it going to be for HSBC to find savings in the coming quarters?
It's a very unique situation. There was a report a few weeks ago in Bloomberg News basically showing that HSBC is investigating one of its key perks for Asia, which for its Hong Kong bankers is some $38,000 a year in school fees that are paid by the bank for their kids. So they're reviewing these. This is obviously a wonderful perk of working there. So the fact that they're looking at that looks to me that they'll be analysing costs in this environment, this quite challenging trading environment. There are a lot of good things to look out for in this reporting season. Standard Chartered arrival last week had its best first quarter earnings on record. That was partly driven by the wealth business. So I think investors will be looking for similar performance from HSBC. So it could be quite a robust quarter.
Now, what are analysts saying about the outlook?
They're very bullish, but obviously challenges in the outlook, given the uncertainty that we're basically all living with what's happening in the Middle East.
All right, Bloomberg's Richard Henderson there. Shery.
Yeah, Paul, and as Richard mentioned, the uncertainty really hitting the markets, of course, a thin liquidity as well. We do have a few markets closed and away on holidays, including here in Japan, South Korea, mainland China as well. But take a look at how futures are setting up, because we had seen the TAIEX now reach record highs. Of course, the AI optimism, anything related to semiconductors really leading to those gains, not only in Taiwan, but also in South Korea. Futures at the moment under a little bit of pressure as Hang Seng futures are also down, and all to do really with the uncertainty that we've been talking about throughout the last few days, throughout the last few weeks, given the ongoing war in Iran now into its third month, and the U.S. and Iran exchanging fire in the Persian Gulf. We've also heard news that Iran has attacked Fujairah port in the UAE. And of course, that has led to a jump in oil prices. Although early in the Asian session, we are seeing a little bit of downside pressure. Do keep your eyes on currencies as well for today, because the offshore yuan, yes, holding at that 683 level, pretty steady as we have seen with Chinese assets in recent weeks, given how much more insulated the Chinese market is against the war in Iran and the energy landscape. We are watching the Japanese yen. Yen intervention dynamics at play, of course, in the exchange market. As, of course, Paul, it's a big day in Australia. We're watching the Aussie dollar as well.
Yeah, absolutely. The Aussie dollar holding up pretty well, and perhaps unsurprisingly, because we're looking ahead to that RBA decision in about 3.5 hours' time. The expectation is we'll see another quarter-point rate hike. That will be the third in a row, and does all the easing that we had in 2025. So that helping support the currency here. We're seeing equities suffering a little, though, off about 2/3%. There's a risk, of course, in the Gulf of Hormuz. Energy stocks bucking the trend, performing quite well. But that is it from the Asia trade. Markets coverage continues as we look ahead to the start of trade in Hong Kong. This is Bloomberg.